Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: How to Stay Sane in the Race to Burnish Your AI Skills. Only 4% of job postings on Indeed mention artificial intelligence, even though AI adoption is now the top concern for job seekers. That single stat, buried in a Wall Street Journal personal journal column, is the antidote to the collective career panic we're watching spread through white-collar work like a contagion. Because panic is expensive, panic makes you buy the wrong training, panic makes you chase the wrong credential, panic makes you confuse motion with progress. And I want to talk about this like an investor, because careers are portfolios. Time is capital, attention is capital, reputation is capital, your ability to compound skill over a decade is the whole game. This moment matters because the headlines are screaming at people from two directions at once. On one side, you've got a software stock sell-off that the columnist describes as the latest reason to reach for the career panic button, unless you're an AI developer. Investors are dumping software companies whose products look vulnerable to AI disruption. You don't need to be an economist to understand what the market is implying about job security inside those companies. On the other side, you've got the policy and macro narrative. President Trump says his pick for Federal Reserve Chair is Kevin Warsh, and Warsh's preference for low interest rates is framed partly around a belief that AI could be deflationary. Sounds great on the surface: lower borrowing costs, relief from price increases, but the column points out the hidden condition. That deflation theory hinges on AI making some employees more productive and putting others out of work. So the mind does what the mind always does in a threat environment. It reaches for certainty, it reaches for checklists, it reaches for credentials, it reaches for the nearest door marked AI certificate, and it starts sprinting. The column's message is, don't sprint, think. Because this is a repeating cycle. Every time a new general-purpose technology arrives, spreadsheets, the internet, mobile, cloud, people overestimate how quickly it will rewrite every job description, and they underestimate how much value accrues to the people who learn it in a targeted way and can prove outcomes. Now let's talk about the central figures in this story. First, job seekers. They're not villains. They're rational. They're staring at headlines. They're watching AI demos. They're hearing that prompt engineering is the new literacy, and they're trying to protect their downside. Their top concerns, according to a new poll by career site Indeed, include AI adoption. Burnout had been the long-running #1 worry in previous surveys. But now AI has climbed over it, because, as the column puts it, you can't get burned out of a job if you get automated out first. Second, recruiters and hiring managers. They're the capital allocators of the labor market. They decide who gets a shot, who gets the interview, who gets the offer. And the column makes a blunt claim. They don't know how much stock to put in a credential from the innumerable online courses out there. Simon Key, Vice President of Client Services and Delivery at the Brixton Group recruiting firm, says formal training programs and certifications on their own will rarely impress employers, given how new and wide-ranging AI is. That's a sharp sentence. It's an incentive sentence. Employers are not paying for your certificate. They're paying for your ability to produce outcomes. Third, the platforms. Indeed is measuring job seeker anxiety and job posting reality. That 4% figure matters because it shows the gap between fear and explicit employer demand. The column also quotes Priya Rathod, Indeed's workplace trends editor, who adds nuance. The overall number includes all sorts of jobs, so it's dragged down by roles like baristas and bus drivers, and white-collar postings may mention AI more. Also, some jobs that would have included AI requirements might have been eliminated and therefore aren't posted. Still, 4% is 4%. The big takeaway is that the world isn't demanding everyone become an AI engineer overnight. Now, the inflection point. AI adoption becomes the top worry. Not because every job demands it today, but because people can feel the direction of travel. Markets are repricing software, the Fed chair conversation is linking AI to deflation. Training programs are multiplying. Everyone is talking about it. So what changes when worry becomes the top concern? People change behavior. They start spending money and time on training. They start collecting certificates. They start narrating themselves as AI skilled, without actually building. This is where the column turns into an operator's guide. It says, rather than let AI panic thrust you into wasted effort, do 3 things instead. Let's treat each of those as a capital allocation decision, because that's what it is. Decision 1. Take a deep breath. This sounds soft, but it's actually hard. It's the discipline to not overreact to salience. Rathod's 4% figure is the anchor here. It's the reason to slow down and pick a strategy rather than letting the market's fear dictate your actions. The opportunity cost of not taking a breath is you waste a quarter, or a year, on misaligned learning. And the hidden trade-off is worse. You may pick the wrong identity. You start branding yourself as an AI generalist when your real edge is domain expertise, compounded by a few high-leverage tools. Decision 2. Get the right training. Here's the best metaphor in the piece. AI training programs are like exercise regimens. Pick the wrong one, and it lets you down harder than a fitness resolution in February. And then the column does something clever. It uses AI to recommend AI training. The columnist prompts Gemini to design an AI course for a handsome and sophisticated Wall Street Journal columnist. Gemini ignores the appearance prompt and suggests a 5-part masterclass in applying AI to elite journalism. Nice. But the course isn't tailored. It includes lessons like combing earnings call transcripts and catching deepfake videos in breaking news situations. Valuable for some journalists, but not especially relevant to a career and workplace trends columnist. Then the column quotes Greg Pagliari, CEO of Randstad Digital, the technology arm of the world's largest staffing agency by revenue. The value of AI training depends on fit, and the substance and focus should match what you're trying to do in your career. Something general will likely have limited impact. So the columnist goes back to Gemini and tightens the spec. They tell Gemini the column is about career and workplace trends. They put a 10-hour time cap to force prioritization. The result is more concrete and on point, learning how to speed up tasks like perusing Glassdoor and choosing the best AI tool for each purpose. That's prompt engineering in its real form. Not clever tricks, not secret templates, just iterative specificity. Ask again, narrow the problem, put constraints on the system, force it to make trade-offs. As an operator, you should hear the subtext. The skill isn't knowing AI. The skill is knowing what you want. Decision 3. Get your story straight. This is where most people fail, and it's where the column is the most valuable. When you finish a course, you'll feel proud. But the column says, earning an AI certificate doesn't make companies see you as a whiz any more than completing a brief workout program makes you look like The Rock. In other words, credentials don't compound. Output compounds. Scott Pulsifer, president of Western Governors University, says you need a portfolio of work you've produced utilizing AI. Evidence. Capstone projects, concrete artifacts that show AI improved your performance. Then you frame the credential properly. Not as a gold star that lands you a job, but as proof you keep learning, that you don't panic in the face of emerging technology. This is narrative as a strategic asset. Now let's do the visuals properly, because this page is full of them, and they matter. On screen, first I want the viewer to see the chart from Indeed's survey. You see a horizontal bar chart with a percentage axis running from 0 to 30%. The title tells you, people looking for work identified their top 3 concerns. The categories include return to office, skills-based hiring, shifting workforce demographics, pressure to upskill fewer entry-level roles, lack of salary transparency, virtual hiring tools, competition for jobs, burnout, and AI adoption. AI adoption sits at the top. Burnout is right behind it. Others trail. What's being measured here is anxiety, not demand. That's critical. It matters because anxiety drives behavior training, spend, career moves, resignation, avoidance. What most people miss is that the survey measures what's loud inside people's heads, not what's written in job postings. And the column's 4% statistic is the counterweight. Next on screen, I want the viewer to see the tech tidbits, because they're not random, they're signals. You see a headline about Chrome changes. Google rolled out AI updates to Chrome, including a Gemini side panel that lives on the right rail of the page. It's like the AI sidebars in Microsoft Edge or Perplexity's Comet browser. The key difference, as the column says, is Chrome is deeply wired into Gmail and the rest of Google's ecosystem. The columnist asks it to draft an email to the author of an article they're reading, saying they didn't like her story and could click send without leaving the page. That's workflow integration. That's not a toy, that's the product moving into the operating system of knowledge work. But then, it failed at a practical task. The columnist went to a Cub Scouts events page, asked it to pull dates and add them to Google Calendar, and it failed. That's reality. These tools are powerful and brittle. The same system can draft an email and fail at basic structured extraction. An operator builds around that with redundancy and verification. Then the page mentions Nano Banana, an image feature. The columnist asks for a penguin on the hood of a Chinese EV. And gets it. That's a reminder that generative AI is not one thing. It's a family of capabilities. Text, vision, image editing, landing unevenly across products. Then, we get Apple's new AirTags, second generation, speaker 50% louder, improved Bluetooth tracking, same price, $29 for one, $99 for four. This is classic product iteration. Not flashy, but it compounds utility. If you've ever hunted keys and missed the gentle chirp, you understand the value of 50% louder. And then there's the advertising schism. OpenAI plans to test ads in ChatGPT for the first time. A turnaround for Sam Altman, who once described advertising as a last resort. The column frames the incentive. OpenAI has committed to spending hundreds of billions in coming years, and it doesn't make hundreds of billions. And Google DeepMind CEO Demis Hassabis is surprised OpenAI would bring ads so soon. On screen, those two paragraphs are the business model laid bare. AI isn't just a technology story. It's a capital allocation story. Compute costs money, model training costs money, distribution costs money. The revenue model eventually asserts itself. Then, my favorite little signal on the page, nothing doing. The hardware company Nothing announces it won't release a phone 4 this year, and instead keeps last year's phone 3 as its flagship. The columnist frames it as a rejection of the upgrade cycle, an annual dance where hardware makers drop flashy new models with incremental improvements. Nothing plans to launch a lower-cost mid-tier option instead. That's founder psychology. That's operator discipline. That's saying, we will not play the market's cadence if it doesn't serve the customer. And finally, the throwback thing. A reader describes how a Nintendo Game Boy Color became a gateway into Pokémon, a diversion from work life, and a travel companion that replaced an IBM ThinkPad on long flights. That's not nostalgia. That's a reminder of product-market fit. Great products don't need an annual upgrade cycle to matter. They earn mindshare and time. Now, the reality check. Here's the uncomfortable truth. AI training is becoming a status good. People are buying courses to feel safe. Employers are not buying that signal at face value. They want evidence. They want you to articulate how AI improves performance. They want a portfolio. Second, uncomfortable truth. The market is right that some software roles and some software companies are vulnerable. But that doesn't mean you personally are doomed. It means the burden of proof in your career is shifting. You will be asked, can you leverage tools to produce more, faster, with less waste? Third, uncomfortable truth. The integration wave is already here. Chrome's side panel, Gmail integration, one-click email drafting. This is workflow displacement. It's not AI is coming, it's AI is inside your daily tools. So let me extract 3 lessons, timeless, operator-grade lessons from this page. Lesson 1. Don't confuse anxiety metrics with demand metrics. Indeed's survey says AI adoption is the top concern. Indeed's job posting analysis says only 4% mention AI. The delta is where bad decisions happen. Your job is to live in the delta without panicking. Lesson 2. Specificity is the new leverage. The Gemini experiment is the model. Ask for a course. Get fluff. Add your job context and a 10-hour constraint. Get a plan that actually fits. In the AI era, the person who can define the problem wins. Lesson 3. Credentials don't compound, outputs do. An AI certificate is not a moat. A portfolio of work that proves you can use AI to improve outcomes is a moat. And the narrative you tell, I'm the kind of person who keeps learning and builds proof, is the wrapper that makes the moat visible. So what's the core question this Wall Street Journal page is really asking? It's asking, how do you stay sane when the world tells you that you need to become an AI pro immediately, and you can't tell which programs are worth your time and money? You stay sane by allocating your time like an investor. You take a breath, you choose training that matches your job, and you leave the course with artifacts, not just a badge. And here's the one sentence I want you to keep. In the AI era, your advantage isn't the certificate you earned. It's the proof you can compound output with new tools without losing your judgment. Moving to next title, Microsoft's pivotal AI product is running into big problems. we have moved past the initial phase of discovery. That's Satya Nadella, writing about AI, saying the industry is entering the phase where we start to distinguish between spectacle and substance. And I want to sit with that line, because it's the line that tells you exactly where the pressure is building inside Microsoft right now. This is from the Wall Street Journal, and it's really a story about a company that knows how to win a platform shift, trying to force itself to win the next one, without confusing motion for progress. Because Microsoft has already done this once. Nadella turned it into a cloud-first company around a decade ago. Azure, subscriptions, enterprise standardization, the slow, grinding compounding machine. Now he wants the same thing again, AI first. And Copilot, this chatbot layer, this assistant embedded into the enterprise suite, Copilot is one of Nadella's top priorities, according to current and former executives. So here's the powerful idea that opens the whole thing up for me. When a company as disciplined as Microsoft makes a product pivotal, you're no longer debating features. You're debating identity, you're debating incentives, you're debating whether the next decade compounds the old moat or rewrites it. And in this case, the pivotal product is running into big problems. Copilot has become central to Microsoft's artificial intelligence strategy as the company's close partnership with OpenAI diminishes. But building Copilot up as a ChatGPT alternative has been tough going. The problems aren't abstract. They're the kind that show up in the messy middle of enterprise software, the place where theories go to die. Confusing brand positioning, interoperability problems, users frustrated, current and former employees saying, plainly, that the product experience is not meeting the promise. And there's one sentence that should make any value investor's ears perk up. Only a small proportion of subscribers to Microsoft's Enterprise Suite use Copilot. Not click it once, use it. And even worse, the percentage who favor it over Google's Gemini or other tools has decreased in recent months. According to data reviewed by the Journal, that's not early innings. That's churn in preference. That's the market voting. Quietly, repeatedly. Now, let me frame why this matters beyond the product. Microsoft shares tumbled after its earnings report sparked investor concern that growth in its most important unit, Azure Cloud Computing, is slowing, and that its AI business is reliant on OpenAI while Copilot remains unproved. This is the investor's nightmare in one paragraph. Slowing core engine, reliance on a partner for the marquee narrative, and the internally branded flagship product, still unproved. Yet, here's the tension. Microsoft is still making many billions from AI-driven cloud computing demand. It's still one of the world's most valuable companies. Analysts still see it well positioned to close the gap because of its productivity software. So the question isn't, is Microsoft doomed? That's not interesting. The question is, can Microsoft convert distribution into adoption? Can it turn the enterprise suite from a delivery vehicle into a behavior change? Can it take something people are forced to license and make it something they choose to use? That's the real game. Now let's talk about the central figure, Satya Nadella. Nadella is the builder. He built the last transformation, cloud first. The article explicitly compares this push to that prior shift. And the thing about Nadella is that he's not chasing AI as a side project. He's doing what great allocators do. He's trying to align the company's identity with the next compounding curve. He's also the allocator, because making Copilot core isn't a slogan. It means real capital, real headcount, real product integration work. It means prioritizing certain roadmaps and deprioritizing others. It means bundling decisions, pricing decisions, go-to-market decisions. And Nadella is also the constraint, because when the CEO declares a product pivotal, the company's tolerance for ambiguity drops. Every internal argument becomes a referendum on that product. Every miss becomes louder. Every win becomes mandatory. Now, you can also feel another central figure on the page: the enterprise itself, Microsoft's installed base, its customers. Because Microsoft doesn't win by persuading millions of consumers to download an app. It wins by embedding itself into how work gets done and then charging for the privilege, year after year. That's why Copilot is such a high-stakes bet. If it works, it's not just a product, it's a toll booth on knowledge work. If it doesn't work, it's not just a failed feature, it's a credibility problem at the exact moment investors are asking whether Azure is slowing and whether Microsoft's AI narrative is dependent on someone else. And this is where the incentives get sharp. Inside the company, people want Copilot to be the ChatGPT alternative. They want it to be the Microsoft answer. But in the customer's mind, that framing might be the problem. Because enterprises don't buy alternatives, they buy outcomes. They buy reduced friction. They buy fewer tools, not more. They buy interoperability that just works. They buy a product that makes them look good internally because their teams actually use it. If Copilot is confusing in brand positioning, it means customers don't know what it is. Is it a chat window? Is it a writing tool? Is it a search replacement? Is it a workflow engine? Is it a security risk? Is it a compliance nightmare? Is it a toy? Is it mandatory? Is it optional? Every one of those questions is an adoption tax. And then interoperability problems. This is the silent killer. Interoperability problems are what prevent the daily habit from forming. They're what prevent the "I used it once" from becoming "I use it every day." They're what keep Copilot from being a muscle memory tool. Now I want to zoom in on the inflection point the article is really describing. The partnership with OpenAI is diminishing. That is a massive change in the system. Because for a while, Microsoft had a simple narrative. We are the enterprise wrapper around the hottest AI. We have privileged access. We have distribution, we have Azure, we have Office, we have everything. But if the partnership diminishes, Microsoft has to stand on its own product identity more directly. Copilot becomes less of a channel and more of a flagship. And flagship products have a brutal rule. They cannot be unproved for long. That's why the Nadella quote about spectacle versus substance lands the way it does. It's almost like the CEO is pre-committing to a harsher internal standard. He's telling the organization, the demo phase is over. Now we get audited by reality. Now let's do the capital allocation and decision autopsy, because this is where value investors actually earn their keep. Decision 1. Make Copilot central. What was expected? The expectation is that Microsoft would convert its enterprise suite distribution into usage, that embedding Copilot into the suite would create default behavior, that enterprises would standardize on it the way they standardize on Word, Excel, Outlook, that Copilot would be the AI layer across Microsoft's ecosystem. What actually happened? So far, the article says only a small proportion of subscribers to Microsoft's enterprise suite use Copilot, and that the percentage who favor it over Gemini or other tools has decreased in recent months. That's a gap between distribution and adoption. Opportunity cost? When you make something central, you create internal opportunity costs. Other product lines get less attention. Other bets get less funding. And you also create an external opportunity cost. If customers don't adopt your embedded tool, they adopt something else. And now you have to compete not just on features, but on habit. Hidden trade-off. The hidden trade-off is that bundling can create resentment. If customers feel they're paying for something they don't use, it becomes a negotiation chip in renewals. And in enterprise, renewals are the compounding engine. You never want to hand a procurement department a clean argument. Decision 2. Position Copilot as a ChatGPT alternative. What was expected? Clarity. If ChatGPT is the category leader in mindshare, then being the enterprise-grade alternative sounds like a shortcut. What happened? The article says confusing brand positioning has frustrated users. That suggests the framing may be muddy. If you're trying to be both the general chatbot and the embedded assistant and the workflow tool, you can end up being nothing clearly. Opportunity cost? Brand confusion delays habit formation. It slows word of mouth inside organizations. And in enterprise, internal champions are everything. If the first champion has a confusing experience, the story dies in the hallway before it gets to the budget. Hidden trade-off? Trying to mirror the consumer narrative can pull you away from your true advantage. Microsoft's advantage isn't being the coolest chatbot. It's being the most integrated tool in the environment where work happens. Decision 3. Tolerate interoperability problems longer than users will. What was expected? The implicit expectation is that users will endure friction because it's integrated, because it's the Microsoft tool, because it's enterprise, because the organization bought it. The article says interoperability problems have frustrated users. That's the market saying, we will not endure friction just because you are Microsoft. We will open another tab. We will use another tool. Opportunity cost? Every frustrated user becomes an anti-marketer. In AI, that's deadly because users compare experiences instantly. Hidden trade-off? Interoperability issues don't just reduce adoption, they erode trust. And trust is the currency that allows you to become the default. Now let's handle the visuals because the page gives us evidence, not vibes. On screen, you're looking at a chart titled As a Measure of Chatbot Preference Among Subscribers. Specifically, the share of subscribers who chose each chatbot as the primary option. The timeline runs from mid-2025 through early 2026. The categories include ChatGPT, Google Gemini, Microsoft Copilot, and Other. What you see is that ChatGPT dominates as the primary choice, while Copilot is a relatively small slice, and that the share favoring Copilot has been shrinking in recent months. This chart is measuring revealed preference, not corporate narrative. It matters because Microsoft can talk about Copilot being pivotal all day long, but the compounding mechanism depends on preference turning into habit, habit turning into standardization, standardization turning into renewals and expansion. What most people miss is that the chart isn't just who's winning the chatbot race, it's a proxy for where trust and utility are accumulating. And where those accumulate, distribution starts to matter less than product love. Also on screen, you see a photo of Scott Guthrie, Executive Vice President of Microsoft's Cloud and AI Group. That image matters for a subtle reason. It reminds you that for Microsoft, AI is not a sidecar. It's tied to cloud. It's tied to Azure. It's tied to the profit pool that already exists. So here's the reality check I want to force. Because investors confuse two different truths. Truth 1, Microsoft is making many billions from AI-driven cloud computing demand. Truth 2, Copilot, as a user-facing AI product inside the enterprise suite, is not yet proving itself in adoption and preference. Those can both be true at the same time. Cloud demand can surge because companies are training models, deploying infrastructure, and paying for compute, while the end-user AI assistant layer remains unproved or underused. And that distinction matters because it tells you where the moat is today and where Microsoft wants it to be tomorrow. Today, Microsoft's AI profit is heavily connected to cloud demand. Tomorrow, Microsoft wants AI profit to be connected to productivity behavior, Copilot usage. Because that's higher quality, that's stickier, that's renewals, that's we can't operate without it. The hard part is that behavior change is slower than infrastructure change. Enterprises will spend on compute, they will experiment, they will approve pilots. But getting a meaningful proportion of Enterprise Suite subscribers to actually use Copilot? That's culture, that's workflow, that's training, that's trust, that's risk management, that's the boring part. And the boring part is where compounding lives. Now, what does this reveal about incentives inside Microsoft? It reveals that Copilot being pivotal creates an internal pressure to show adoption. That pressure can lead to feature proliferation. It can lead to branding chaos. It can lead to forced bundling. It can lead to selling the dream rather than fixing the interoperability. And it also reveals a broader pattern I see across great companies. Most failures come from success carried too far. Microsoft succeeded by bundling and standardizing the enterprise. If it tries to apply the same playbook too aggressively to AI, before the product experience is undeniable, it risks turning a potential habit into a reluctant add-on. So let me extract 3 lessons, the kind you can reuse for decades. Lesson 1. Distribution is not adoption. A company can have the greatest distribution engine on earth and still lose preference. AI tools are compared in real time. The switching cost for the individual user can be low even when the switching cost for the enterprise contract is high. Lesson 2. The highest quality profit comes from behavior change, not infrastructure spend. Infrastructure spend is cyclical and competitive. Behavior change embeds you into the customer's daily workflow. That's the kind of moat that compounds quietly. Lesson 3. Brand clarity is a form of capital discipline. Confusing brand positioning is not a marketing problem. It's a capital allocation problem because it wastes the scarcest resource you have, the customer's attention and trust. Now I want to end where the article begins, at spectacle and substance, because Nadella is telling you the standard is about to rise. The initial discovery phase is over. Now we're in the audit phase. And the audit is simple, not measured in keynote applause, not measured in press releases, measured in whether a meaningful share of Microsoft's enterprise subscribers actually uses Copilot and prefers it when no one is watching. So what's the core question this raises for me as a long-term investor? It's whether Microsoft can do what it's best at, turn a tool into a default, without letting the AI moment push it into hurried decisions that create resentment and confusion. And here's the one sentence I'll leave you with, the one you can keep for years. In the shift from spectacle to substance, the winner isn't the company with the best demo, it's the company that turns preference into habit and habit into compounding cash flow. Moving to next title, Dell's son seeks to shore up Texas power with battery firm. Zach Dell has raised more than $1.3 billion to put battery packs in Texas homes, and he's adding more than 50 customers a day. That's the opening fact pattern in this Wall Street Journal story. And it matters because it's not really about batteries. It's about capital allocation under stress. It's about what happens when a public utility problem, grid reliability, gets pulled into the private market and packaged as a subscription. I want you to notice the structure. Texas, hurricanes, winter storms, power outages, an aging electricity system. Federal regulators warning that power demand is outpacing infrastructure development. When systems strain, entrepreneurs don't just sell products. They sell certainty. They sell the feeling of control when the base layer fails. That's what base power is selling. And when I hear a business like this described as subscription, my investor brain immediately asks, is this a good business, or is this a financing structure pretending to be a good business? Because subscriptions can compound if they're attached to real utility, a real habit, a real switching cost, and a cost structure that doesn't blow up when you scale. So let's treat this story as the thing it is. An early-stage attempt to create a new kind of distributed utility, one home at a time. Now, the central figure, Zach Dell, 29 years old, son of Michael Dell, the billionaire computer pioneer, co-founder and chief executive of Base Power. And what I like here is that the article doesn't lean on lineage as destiny. It uses it as context. Zach Dell explicitly says Michael Dell is not an investor in the business. I wanted to do my own thing, Zach says. That sentence is an incentive sentence. If your father is a world-class operator and allocator, you're either going to live under that shadow or you're going to build a separate scoreboard. Zach is building a separate scoreboard. But he's also not pretending he's immune to the benefits of proximity. The article says his father offers advice on developing hardware, supply chains, working with customers, and fundraising. And Zach says, honestly, that he ignores some counsel and absorbs some. Sometimes he thinks his father doesn't understand the specific thing he asked about. Other times, he gets advice that makes him realize he was not thinking about the right way at all. That's what good founder development looks like. Not obedience, not rebellion, selective absorption. Now, define Zach Dell's role the way we always do. Builder, allocator, constraint. Builder. He's building a home battery company that says it's adding over 50 customers a day in Austin, Dallas, Fort Worth, Houston. He's building something meant to scale installations quickly, to become repeatable, to become boring. Allocator. He's allocating the $1.3 billion plus raised into multiple fronts at once: manufacturing, field operations, retail power provision, and power trading. The article says Base Power will expand its energy storage and power electronics factory located in the former Austin American Statesman building downtown. Instead of assembling third-party components, it will start manufacturing its own battery modules and inverters. That's vertical integration. That's a decision with teeth. Constraint. His constraints are not just technical, they're organizational. He's building several businesses at once. He says it's like 10 companies in one. He calls it a complex coordination machine. And that phrase, coordination machine, tells you exactly where the real risk sits. It's not in the chemistry of batteries, it's in the human and operational layer. What worked in the market for a long time was the assumption that grid reliability is a given. You paid your bill, you got electricity. What quietly stopped working is that reliability is no longer stable, and people have started assigning a real price to outages, especially in a state where weather can knock out power hard and for long stretches. This is the inflection point: grid fragility turning into a consumer product category. And Base Power's wedge is clever. It's not asking the homeowner to spend $10,000 up front, it's offering a lower friction entry, $695 to install one unit, plus a $19 monthly subscription fee, plus the electricity bill based on usage. Then it anchors you with a rate. Current energy rate, 8.5 cents per kilowatt hour, rising to around 14.3 to 14.5 cents after adding utility transmission and distribution costs. The article cites Texas residential rates averaging 16 cents in November. So Base Power is selling you two things in one bundle: backup power and potentially lower than average electricity. That dual promise is important. Backup power is emotional value. Lower rate is rational value. Emotional plus rational is how subscriptions stick. Now let's do the decision autopsy. Capital allocation under the hood. Decision 1. Own the batteries and act as a retail power provider. What was expected? Expected, control customer experience, capture margin, earn recurring revenue, and create a relationship that is stronger than a one-time hardware sale. What actually happens in the model? If the lights go out, the batteries can power a home for a day or two, depending on the size of installation. Opportunity cost? Owning hardware is capital intensive. It can turn you into a balance sheet business. It can force you into constant fundraising. It can make growth look like success, while cash burn tells a different story. Hidden trade-off? Owning the battery makes you responsible for maintenance, performance, and replacement. Your brand is now tied to physics. Decision 2. Aggregate the batteries and trade power like a single plant. What was expected? Expected. Turn a scattered set of residential batteries into grid asset value. Make the virtual power plant economics real. What actually happened so far? The company has more than 10,000 customers and about 200 megawatt hours of installed capacity. When the grid is up, they use the batteries to support the grid. When it's down, customers get the battery back. Opportunity cost? Power trading is a different muscle than consumer operations. It brings regulatory relationships, forecasting, risk management, and sometimes political heat. Hidden trade-off? If you optimize too hard for grid support, you can accidentally violate the core promise. Backup certainty for the homeowner, right when it matters most. Decision 3. Standardize hardware like Henry Ford. This is explicit. Justin Lopez, the co-founder and chief operating officer, former head of manufacturing at Anduril, says they want manufacturing to be the same every time. You either get 1 or 2 and that's it. He says it's like Henry Ford. Any color as long as it's black. Expected, scale installations quickly, keep costs down. Actual, a pathway to operational compounding, if they execute. Opportunity cost, less customization might lose certain high-end customers. Hidden trade-off, standardization simplifies manufacturing but forces you to be perfect at the few variants you offer. There's nowhere to hide. Decision 4. Vertical integration into modules and inverters. Expected, reduce dependence on third parties, improve margins, stabilize supply chain, and tailor product to their unique needs. Actual, factory expansion, manufacturing plan, batteries getting larger. Opportunity cost, capital spend, execution risk, and the classic trap manufacturing problems can eat a young company alive. Hidden trade-off, once you're building your own components, your failure modes multiply. Now let's do the visuals and make the listener see it. On screen, you see the photo. Zach Dell standing with the base power setup. This is a physical business, not software, not a download. You're looking at a founder trying to bring industrial scaling discipline into residential neighborhoods. On screen, you also need to picture the battery unit itself as described. The units are typically installed outside next to the customer's electric meter. They're smaller than an air conditioning unit, about 2 feet wide and deep and 3 feet tall. That's important because it tells you adoption friction. If it looked like a refrigerator, people would resist. If it's roughly the footprint of a small outdoor box, you can imagine it becoming normal, like a generator, like a grill, like an HVAC compressor. And then you see the numbers as evidence. 10,000 customers, 200 megawatt hours installed capacity, over 50 customers a day being added, $695 install, $19 subscription, 8.5 cents per kilowatt hour before T&D, about 14.3 to 14.5 after, versus 16 cents average in November. That is the evidence stack. Now, the reality check. The moat is not battery. Batteries commoditize. Hardware commoditizes. Supply chains normalize. The moat, if there is one, is execution across the 10-company problem. Consumer brand and customer service. Manufacturing and supply chain management. Field operations. Install and service. Retail power provision and billing. Power trading and grid participation. Utility relationships, including rural electric cooperatives. This is why Clay Dumas at Lower Carbon Capital invested. He believed Dell and Lopez assembled the talent to pull it off, were meeting targets, and that the model would be difficult to replicate. Difficult to replicate is what we look for, but it cuts both ways. It can mean defensible. It can also mean fragile. The question becomes, can they make the machine boring before the machine breaks? Now the 3 lessons. Timeless, reusable. Lesson 1. Reliability is a product. When the base system becomes less reliable, entrepreneurs can sell reliability as a service. But the service must be real when stress hits, or the brand dies. Lesson 2. Subscriptions compound only when they are attached to hardware discipline. A subscription layered on top of a failing operational system is just deferred disappointment. Lesson 3. Standardization is the fastest path to scale and the fastest path to catastrophic embarrassment. Henry Ford works when quality is controlled. If not, it scales defects. So let me answer the core question that sits beneath the headline. Can base power shore up the Texas grid and build a compounding business at the same time? Yes, but only if they win the coordination game. Because the customer isn't buying a battery. The customer is buying certainty. And here's the one sentence I'll leave you with. In infrastructure, the winners aren't the ones with the best technology. They're the ones who turn complexity into a repeatable system before the next storm arrives. Moving to next title, CoStar faces new shakeup push. D.E. Shaw is calling Homes.com a high-risk, money-losing investment and saying CoStar needs a leadership change because the pace and oversight aren't good enough. That's not noise, that's capital speaking. That's one of the biggest shareholders looking at a company with a roughly $22 billion market value, seeing the stock down more than 20% year-to-date, and deciding the root cause isn't the market, it's management, it's governance, it's capital allocation. This is from the Wall Street Journal, and it's a story I love because it's the purest form of business reality. A dominant operator in one niche tries to expand into an adjacent consumer market, burns money doing it, and suddenly the shareholder base stops being polite. And every time I see this pattern, I think, most corporate failures aren't caused by weakness. They're caused by strength carried too far. Strength that creates confidence, and then confidence that creates overreach. CoStar was built on being the dominant force in commercial real estate data. It became the go-to source for office market data, building dimensions, sales, all those hard facts that professionals pay for because they must. Then it expanded into hotels, apartments, other property types. That's a compounding business. Data, workflow, switching costs. Then the founder pushes into the single-family housing market, long dominated by Zillow Group and Realtor.com, through Homes.com. And that's the pivot where the incentives change. Because commercial real estate data is sold to professionals. It's subscription. It's high retention. It's rational. Single-family consumer platforms are a different species. They're marketing heavy. They're brand heavy. They're traffic driven. They're expensive to buy share in. And, this is the key, they can look like investment for a long time without proving they're a business. Now let's identify the central figure. Andrew Florance. Founded CoStar in the 1980s, built it into the dominant force in commercial real estate data. That's builder DNA. But the same builder DNA can become a constraint when the builder becomes anchored to a strategy that the market no longer believes in. D.E. Shaw says Florance is anchored to an unsuccessful Homes.com strategy. It says the board is unable or unwilling to faithfully perform its critical oversight function. Those are not casual words. That's not "we'd like some tweaks." That's "we don't trust the decision system." And it's not just D.E. Shaw. The company is already facing pressure from Third Point, run by Daniel Loeb, which says it plans to nominate a fresh slate of director candidates. Third Point also wants CoStar to consider strategic alternatives for Homes.com and related businesses. So you have a governance fight forming around one question: is Homes.com the right use of capital? Now the inflection point. Last year, D.E., Shaw, Third Point, and CoStar reached an agreement that averted a big proxy fight. That agreement expired last week. And what happens when the guardrails expire? The knives come out. D.E. Shaw goes public with a letter. Third Point escalates. CoStar responds with hostility, saying Loeb is acting like a child and accusing D.E. Shaw of latching onto Third Point's dangerously misguided effort to have CoStar abandon Homes.com. When you see language like that, you're no longer in a quiet disagreement about strategy. You're in a legitimacy battle. Now let's do the decision autopsy, because this is where investors should slow down and think. Decision 1. Expand into single-family housing via Homes.com. What was expected? A larger total addressable market. A second engine. Diversification. A consumer-facing brand to complement the professional data machine. A path to durable long-term shareholder value. as CoStar's spokesperson claims. What actually happened? According to the shareholder rebellion, the stock underperformed. Investors fear the company is overspending and facing stiffer competition. D.E. Shaw calls Homes.com high risk and money losing. And now you have two activist funds pressing for changes. Opportunity cost? The opportunity cost is brutal. Every dollar spent chasing consumer traffic is a dollar not spent reinforcing the core compounding engine. Commercial real estate data dominance, pricing power, product depth, distribution into professional workflows. Hidden trade-offs? The hidden trade-off is cultural. A company optimized for B2B data compounding has to adopt different reflexes to win consumer attention. That can distort incentives internally. You start rewarding growth narratives over cash discipline. You start treating losses as investment for longer than the market will tolerate. Decision 2. Governance posture, how the board supervises the bet. D.E. Shaw says the board is failing its oversight function. That's the most important accusation in the whole piece, because it reframes the risk as structural, not tactical. If oversight is weak, then even a good strategy can turn into a money pit. Decision 3. What D.E. Shaw wants now. Monetize, refocus, buybacks, comp restructure. D.E. Shaw wants CoStar to find ways to monetize Homes.com, refocus on the core business, buy back stock, and restructure executive compensation. Expected result? A return to capital discipline. Less narrative. More math. Less one big bet. More measured allocation. But note the trade-off. Refocusing can protect margins and buy time, but it may also concede the consumer platform race. And conceding a race can be rational if the race is structurally unprofitable for you. Now, I want to handle the visuals. Even though the chart on this page is actually about Eli Lilly's quarterly revenue. On screen, you see a simple clean line or bar chart showing Eli Lilly's quarterly revenue. With a call-out, $19.29 billion, up 43% year over year. That matters here not because it's Lilly, it matters because it shows what clean evidence looks like. In one glance, you see an outcome driven by demand and volume. You see growth that is measurable. You see a business where the unit economics are not hidden behind investment phase language. Then, contrast that with Homes.com, which D.E. Shaw describes as money losing. Different businesses require different patience, sure, but the market's patience is always inversely correlated with clarity. The clearer the evidence of compounding, the more time you get. The fuzzier the evidence, the faster activists arrive. Now the reality check. The uncomfortable truth is that activists usually show up when a story stops working. Not when it starts. CoStar's expansion may have been cheered early, but once the stock is down more than 20% year to date and investors think spending is too high, the narrative flips, and then everything becomes political. The founder becomes anchored. The board becomes unwilling. Comp becomes a demand. Strategic alternatives become the threat. So what's the core question raised by this article? It's whether CoStar can justify Homes.com as a durable value creator, or whether Homes.com is the kind of success-shaped failure where a company's dominance in one arena convinces it can win in another arena that plays by different rules. My answer, strictly within what the article gives us, is this. The shareholder base is signaling that the burden of proof has shifted. CoStar can't just say long-term value. It has to show how Homes.com becomes monetizable and how the core compounding machine is protected while that happens. And I'll end with one sentence you'll remember for years. When activists attack, they're rarely arguing about vision. They're arguing that the company's capital is being spent as if time is infinite, when the market is telling you it isn't. Moving to next title, new Disney chief is Park Insider. Tomorrowland still hasn't been updated, and there's no plan to do it as part of Disney's $60 billion parks investment. That's the sentence I can't stop thinking about. Because that sentence isn't about a land in Disneyland, it's about how capital gets allocated inside a giant brand when the math isn't clean, the creative stakes are high, and the leader in charge is being judged not just on earnings, but on taste, restraint, and timing. This is the Wall Street Journal, and what I'm holding in my mind as I read it is that Disney is not one company, it's a system. It's a flywheel. Stories create characters. Characters create demand. Demand gets monetized in physical places, and those physical places are engineered to extract value in a way that feels magical instead of transactional. And now the company has chosen its next chief executive from the part of the system that prints the money. experiences, parks, cruise ships, the real world, the place where guests walk in and the meter starts running. So the moment matters because Disney is picking a CEO who has lived in the profit pool, not just visited it, managed it, optimized it, pushed it, defended it. And when you do that, you learn a hard truth. The cleanest looking numbers often come from the messiest human decisions: pricing, lines, access. The feeling that the brand is still for families, even as the company has to extract more value from the people willing to pay. That tension is the Disney story right now. The central figure is Josh D'Amaro, theme park leader, park insider, and I want to talk about him the way I'd talk about any leader who's about to inherit a compounding machine. As a builder, an allocator, and a constraint. Builder first. D'Amaro's direct experience managing creative talent comes through Walt Disney Imagineering, the group that designs every ship, theme park, and restaurant for the company. That's not a normal management environment. You're dealing with artists and engineers and accountants and safety experts and storytellers. You're dealing with the kinds of people who can make something unforgettable, and the kinds of people who can tell you exactly why your unforgettable idea violates physics, budgets, and human patience. In 2023, D'Amaro brought back a respected veteran to run Walt Disney Imagineering and revive morale that had been battered by layoffs and budget scrutiny. That's builder behavior. Not because it's glamorous, but because it acknowledges that creative organizations don't run on org charts. They run on morale, they run on belief, they run on the feeling that the work matters, and that leadership has your back when the spreadsheets come out. Now look at what that Imagineering team is doing. The article says it's the busiest it has been in decades. New attractions based on Monsters, Inc. and The Lion King, a new theme park in Abu Dhabi, a cruise line that's nearly doubling in size. That's a pipeline. That's backlog. That's CapEx turning into future cash flow, if executed well. Allocator second. D'Amaro is also a frequent visitor to Epic Games headquarters in North Carolina, where developers are working on a Disney virtual world. He championed using Epic's Unreal Engine to speed development across the company, including an update to a Millennium Falcon ride based on the coming Mandalorian and Grogu Star Wars film. That's not a random tech anecdote. That's an allocator's instinct. Shorten iteration cycles, reduce time to quality, and build a common toolchain that makes creative output more scalable. Time is money. In Disney's world, time is also relevance. If it takes too long to build and update, the culture moves on, and the park becomes a museum of yesterday's hits. Constraint third. And here's where it gets interesting, because the article gives you a human downside that matters. People who have worked with him say D'Amaro likes to be liked. His reluctance to take decisive stands has caused tension with colleagues at times. You can already see the conflict this creates. Disney's best outcomes often require decisive stands, not just creative stands. Financial stands? Stands that make some guests unhappy now so that the system works in 10 years. If you want to be liked, you can drift. You can keep reopening decisions. You can spend money on ideas without committing to one. And that's exactly what the article describes in the Tomorrowland saga. After Bob Iger returned, he toured Disneyland and told D'Amaro that Tomorrowland looked out of date and was hurting the company's reputation. Imagineers started working up designs, but Disneyland executives worried the estimated costs, ranging from $500 million to $1.5 billion, weren't worth it. So what happens? D'Amaro goes back and forth on the issue for years. He spends millions of dollars to develop different ideas. And Tomorrowland still isn't updated, and it's not part of the $60 billion parks investment. That is the purest example of capital allocation failure mode that looks reasonable in the moment. You don't want to commit to a massive project when the economic case isn't clear. You also don't want to ignore a reputational problem identified by the CEO. So you do the middle thing. You study, you iterate, you ask for more concepts, you spend millions. And the hidden cost is that you pay for indecision twice. You pay in dollars, and you pay in time. Now, I want to step back and show you why D'Amaro is even here, why he won this job. The article traces his path in a way that tells you what kind of operator he is. He studied art at Skidmore College before deciding it wouldn't set him up for career success. He transferred to Georgetown and got a business degree. He spent 6 years at Gillette, the razor company, and then took a business planning job at Disneyland in 1998. He develops expertise in pricing, marketing, and logistics, the unromantic mechanics that make theme parks work. That's a specific skill set. It's the skill set of running a high-throughput emotional factory. He gets the attention of senior executives in 2010 when he takes over a moribund, money-losing travel division called Adventures by Disney. When he moves on 3 years later, it's turning a profit. That's a turnaround. It's not just a brand job, it's an operational fix. Then colleagues credit his success at Adventures and later roles running Animal Kingdom, Disneyland, and Walt Disney World to his ability to energize cast members and get to know guests. He spoke to Walt Disney World visitors in their homes as part of a project to learn what changes they wanted to see, and one result was improved service at the resort's hotels. That's very telling. That's not the stereotype of a Disney executive in a conference room. That's someone trying to understand the customer at the level where loyalty is formed. The lived experience. There's also a quote that explains how he operates internally. At Animal Kingdom, cast members were skeptical about adding a land based on the Avatar movies to a park focused on wildlife. But someone who worked with him says DeMauro didn't just recognize the value of the land, he rallied the team around the why behind it. He cared about commitment, not compliance. That's leadership. That's persuasion. That's culture building. And culture building is a compounding asset until it becomes a hesitation to make enemies. Now, we reach the inflection point in the story. Optimization meets the limits of public perception and macro reality. Disney has been criticized by fans for price increases and policy changes that make parks less affordable for middle-class families. But behind the scenes, DeMauro looked for ways to get more money from wealthier visitors while maintaining cheaper options for people willing to come on weekdays or wait in longer lines. That is price discrimination. That is yield management. That is airline logic applied to a theme park. And if you do it well, it's beautiful. You monetize willingness to pay without destroying the brand's promise. But you can also over-optimize and trigger backlash, because people don't just buy a ticket. They buy the feeling that the experience is fair. And the article gives you the most concrete evidence of that strategy: ticket pricing and lightning lanes. DeMauro tried to increase profits by charging more on the busiest days and for shorter lightning lanes, rather than across-the-board price hikes. The most expensive one-day ticket at Disneyland has soared to $224, plus as much as $449 for a lightning lane premier pass. At the same time, he has kept the lowest entry price at $104 since 2019. That's the whole strategy in numbers. Keep the entry-level anchor stable, extract more value at the top, and make the peak days and convenience features the profit center. Catherine Powell, who previously oversaw Disney's theme parks in the US and Europe and now runs AMA Waterways River Cruises, says DeMauro was mindful and sensitive about entry-level affordability, especially for young families. And another colleague, Jim McPhee, former chief operating officer of Walt Disney World, sums him up with one word: optimization. He says DeMauro focuses on how to extract the most value. That word, extract, matters. Because extraction is what investors want. Extraction is also what customers feel when the magic becomes a pricing algorithm. Now let's do the capital allocation and decision autopsy, the part that really separates a good operator from a legendary one. Decision 1. The $60 billion parks investment, and what it includes and doesn't include. What was expected? When you commit that much investment, you expect the iconic weak points to get fixed. You expect reputation issues to be addressed. You expect the most visible, out-of-date land in Disneyland, Tomorrowland, to be on the list. What actually happened? Tomorrowland still hasn't been updated. It's not part of that investment plan. Opportunity cost? The opportunity cost is the compounding loss of relevance in a land that's supposed to represent the future. The longer it stays outdated, the more it undermines the brand promise. And if Iger is right that it hurts reputation, that has second-order effects. It shapes how people talk about the parks, how they post about them, and whether they perceive Disney as innovating or milking nostalgia. Hidden trade-offs? The hidden trade-off is that Tomorrowland is expensive and risky. $500 million to $1.5 billion in estimated cost, with an unclear economic case. So you defer. But deferral has its own cost, especially when you've already spent millions iterating concepts. Decision 2. Invest in creative throughput and morale. Bringing back a respected veteran to run Imagineering in 2023 is a bet that morale is an input to productivity. What was expected? Better execution, faster delivery, a creative machine that doesn't stall under budget scrutiny. What actually happened? The team is described as the busiest in decades, building multiple attractions, a new park, and expanding cruise line. Opportunity cost? More projects at once means more risk of bottlenecks, more risk of delays, and more risk of quality slipping. You can stretch an organization so thin that everything becomes good enough, and good enough is poison in a premium brand. Hidden trade-offs? The more you rely on creative talent at scale, the more leadership has to protect that talent from cynicism and burnout, especially under cost pressures. Decision 3. Speed development through Epic and Unreal Engine. What was expected? Faster iteration, better pipeline, a shared technical foundation. What actually happens? Tomorrow champions Unreal Engine usage across the company, including for a Millennium Falcon ride update tied to a coming Star Wars film. Opportunity cost? When you standardize on a tool chain, you take on dependency risk and organizational change costs. Training, integration, the friction of new workflows. Hidden trade-offs? Tech doesn't fix taste. Speed can increase output, but it can also increase the volume of mediocre ideas. The real question is whether the faster cycle improves quality or just accelerates churn. Decision 4. Pricing strategy and lightning lanes. What was expected? Increase profits without alienating entry-level customers. Extract more from peak demand and convenience seekers. Preserve affordability optics with a stable low-price anchor. What actually happened? Top ticket prices surged. Lightning Lane Premier Pass can add up to $449. The lowest entry price stays at $104 since 2019. Opportunity cost? The opportunity cost is brand trust. If too many guests feel nickel and dimed, the system starts to leak loyalty. And loyalty is Disney's real moat? Hidden trade-offs? You can build a two-tier park experience. One for people who pay to skip friction, one for people who absorb friction. That may maximize revenue, but it risks changing the social fabric of the park. Now, the visuals. Because the visuals are part of the evidence, and the viewer needs to feel them. On screen, you're looking at images connected to the theme park leader Josh D'Amaro and Walt Disney World in Orlando. Let that sink in. You're seeing the physical asset, the castle, the place that turns stories into cash, the kind of place you can't replicate quickly, no matter how much money you have. And you're seeing the person who has been inside that machine, learning how it breathes. And on screen, you also see the idea of D'Amaro as a public face, because the article describes him as one of Disney's best-known public faces, besides Iger and producers like Marvel's Kevin Feige. He maintains a popular Instagram account with 173,000 followers, giving people a casual look behind the scenes that they aren't used to from Disney's tightly controlled publicity machine. When he unveiled plans for the parks at Disney's D23 fan convention, he got a rock star-sized reception. A fan site operator says within a year of being at Disneyland, D'Amaro became a pseudo-celebrity people stop and ask for selfies. That matters because perception is a form of currency in this business. If the park's leader is beloved, he can buy goodwill during price changes. He can sell controversial decisions with trust. But that same desire to be liked can also make it harder to make unpopular but necessary stands. Now the reality check. This is where we get honest about what the data and anecdotes are telling us. Disney shareholders will be looking for D'Amaro to generate value after 5 years in which Disney significantly underperformed the broader market. At the same time, the company is facing headwinds like a decline in foreign visitors to its U.S. theme parks. So the park's profit pool is not a guarantee. It's a machine that must be tuned continuously. And D'Amaro is stepping into a political environment that's described as difficult. Disney has clashed with the Trump administration over late-night host Jimmy Kimmel, with Florida Governor Ron DeSantis over LGBTQ rights, and with Senator Bernie Sanders over employee wages. D'Amaro, unlike Iger and Walden, is described as a registered independent, and his recent political donations have been to Disney's corporate PAC. That's not trivia. That's governance risk. That's stakeholder management. The Disney CEO role is not a pure business role. It is a role where politics, labor, culture, and brand collide. Now, I want to extract 3 lessons, timeless ones, for investors and operators. Lesson 1. Optimization is not strategy. Optimization is a powerful tool. It can extract value. It can tune pricing. It can increase profit. But strategy is choosing what not to optimize, because some things are sacred to the brand, and some risks are worth taking even when the economic case isn't perfectly clear. Tomorrowland is the symbol here. The economic case was unclear. The estimates were massive, the decision drifted, and the cost of drift compounded. Lesson 2. The real moat is guest trust. Disney can raise the top-end price and still keep the lowest entry price stable, and on paper that looks brilliant. But the moat is not the spreadsheet. The moat is the guests' feeling that the experience is fair, that the magic is intact, that the brand still respects families. If that moat cracks, no amount of Lightning Lane revenue can patch it long-term. Lesson 3. Creative organizations compound when leadership protects morale and chooses decisively. Bringing back a respected veteran to revive Imagineering morale is a compounding move. But compounding requires follow-through. It requires decisions that don't just generate ideas, they ship realities. And now, the core question the article raises for me. What kind of Disney CEO will Josh D'Amaro be? Will he be the optimizer who extracts the most value from the machine that exists? Or will he be the allocator who takes the hard reputation-shaping bets that rebuild the machine for the next generation, especially when the economic case isn't perfectly clean? The board chairman says D'Amaro's decisiveness and clear thinking impressed the board. The article also shows moments where decisiveness was hard. That tension is the whole story. And I'll end with the one sentence I want you to remember for years. In a brand like Disney, the CEO doesn't just allocate capital, he allocates trust. And trust is the only asset that compounds when prices keep rising. Moving to next title, Big Tech throws cash to India in AI quest. India produces about 20% of the world's data, but houses only 3% of it. That single imbalance explains almost everything on this page. It explains why US tech giants are pouring money into Indian data centers. It explains why the Indian government is offering a 20-year tax break on overseas revenue from global data services based in India. And it explains the tension that always shows up when a country tries to move up the value chain. Energy, water, jobs, and sovereignty all collide in the same concrete building full of servers. This is the Wall Street Journal, and the story is framed as Big Tech throws cash to India in an AI quest. But as a value investor, I want to translate that phrase into something more precise. This isn't just cash. This is long-duration capital allocation into infrastructure. This is the modern version of railroads and ports. The AI economy doesn't run on clever prompts. It runs on compute capacity, bandwidth, power, and real estate. And it runs on legal rules about where data is allowed to live. So what we're watching is not simply a technology trend, we're watching a remapping of global production. Now, why does this moment matter? Because when the hyperscalers make tens of billions of dollars of commitments in a country, it changes the bargaining power on both sides. It changes the tax base. It changes regulation. It changes the labor narrative. It changes geopolitics. And it creates a new kind of lock-in. Not software lock-in, but infrastructure lock-in. Once you build the data center and lay the cable, the decision isn't reversible on a whim. Let's identify the central figures, because this story has multiple decision makers, and each has a different incentive function. On one side, you have the US AI titans and the big US data center firms, hyperscalers, racing to establish AI leadership not only in the US, but around the world. They're drawn to India because of the scale. 1.4 billion consumers, described as massive and digitally savvy, and some of the most prolific users of data and AI chatbots. On the other side, you have the Indian government, Prime Minister Narendra Modi's administration, trying to pull off a specific kind of industrial policy. India wants to become a major provider of AI services, including low-cost tools to solve local problems, while leaving cutting-edge foundational model innovation to deep-pocketed companies in the US and China. That's a very deliberate stance. It's basically saying, we're not going to burn the national balance sheet trying to OpenAI. We're going to win the services layer. We're going to win deployment. We're going to win the global operations layer. And India's technology minister, Ashwini Vaishnaw, says this gives India the opportunity to become a major AI hub. Now comes the inflection point: data sovereignty and tax certainty. The government announces plans to give tech companies a 20-year tax break on overseas revenue gleaned from global data services based in India. That line is not a headline grabber to most people, but to investors and CFOs, that is a permission slip. It removes uncertainty. The article explicitly says there had been uncertainty about how Indian authorities would tax global companies setting up data centers in India, and what share of global revenue might be deemed taxable due to that presence. A tax lawyer, Himanshu Sinha of Trilegal, says the tax liability could have been quite high, and disputes would have arisen. So the policy is doing two things at once. It attracts capital, and it de-risks future litigation and conflict around tax exposure. This is classic, make the rules clear, and the money shows up. And the money has already been showing up. The article lists a cluster of very large commitments in just the past few months. In October, Alphabet's Google announces a $15 billion investment in data centers in southeastern India, plus undersea cable links, calling it the largest single AI hub outside the US. In December, Microsoft unveils its largest ever investment in Asia, a $17.5 billion pledge to develop India's cloud and AI infrastructure. And on the same day, Amazon pledges to invest $35 billion across its operations in India up until 2030. Now, as investors, we should pause and do the capital allocation autopsy. What was expected when these companies allocate this kind of capital into India? Expected: access to a gigantic user base, faster growth in AI usage, and local infrastructure that supports global AI services. Expected also regulatory compliance, because India's new data privacy regulations will require companies to store Indian user data locally. That's not optional. That's a forcing function that makes local compute and storage strategic, not merely nice to have. What actually is happening, based on what the article says? India is becoming one of the hottest markets globally for these investments, and the commitments are accelerating. The government's tax break removes uncertainty and incentivizes companies to look beyond serving India's data needs alone, already a large market, and establish global service centers. Opportunity cost for the hyperscalers: every billion spent in India is a billion not spent elsewhere. But this is not charity. They're buying a foothold in a market where data usage is exploding, where regulation is pushing data to stay local, and where the next wave of AI adoption could be enormous. Opportunity cost for India. India has to allocate scarce resources, grid power, water, land, political attention, to data centers that employ only hundreds of people. And that's a painful mismatch when a government is under pressure to create jobs for millions of new graduates every year. This is where the trade-offs become real. Now let's talk about the evidence the viewer will see on screen, because this page is heavy on visuals. On screen, you see a photo of a data center in Navi Mumbai, India. It's not glamorous. It's a long corridor, industrial lighting, racks and cabling, a feeling of engineered density. The point of showing it isn't aesthetic. The point is to make you feel that AI is physical. It lives in buildings. It needs cooling. It needs power. It needs water. On screen, you also see a huge stock table. Prices, tickers, highs, lows. Because this is the Wall Street Journal. And I actually like that juxtaposition, because investors stare at tickers all day and think the market is abstract. Then a story like this reminds you. The thing you own is going to pour concrete, negotiate electricity, lay undersea cables, and deal with regulators. Now, the uncomfortable reality check. The article is clear that there is pushback and constraint. Environmentalists warn that India's water-stressed cities could struggle with the additional demand from data centers. Policymakers are trying to figure out how the patchwork electricity grid will provide enough power to the new centers. Some government quarters are cautious about how quickly India can add data center business given electricity and hardware constraints. And some communities fear they will lose out, as power and water are earmarked for data centers that need ample supplies of both. This is the politics of scarcity. When resources are plentiful, investments are celebrated. When resources are scarce, investments are contested. And data centers are resource-hungry in exactly the way that makes them controversial. They consume a lot, and they employ relatively few. That last point is explicit. Data centers employ only hundreds of people, and Indians have begun questioning whether their expansion will deliver new employment. Now bring this back to the national strategy. India has been successful for decades in attracting global tech firms for operations. Call centers, back-office work, large labor-intensive services. Data centers are different. This is capital-intensive infrastructure with a much smaller headcount. So the job story is weaker, which means India's government is trying to shift the narrative from jobs to hub, from employment engine to platform. from back office to frontier infrastructure. And the article underscores the frontier logic. The investment costs to develop foundational models are prohibitive for India, the government says in a recent economic report. Officials say India must not squander money trying to beat OpenAI or DeepSeek, and should instead deploy AI cost-effectively and build an AI services business. That's a sober, almost value investor-like framing from a government. Don't compete where you don't have an edge. Build where you do. Now I want to extract 3 lessons. Timeless ones. Lesson 1. Policy clarity is an economic moat. A 20-year tax break on overseas revenue from global data services based in India is not just a tax incentive. It's a coordination mechanism. It reduces fear, reduces friction, and pulls forward capital investment. Lesson 2. In AI, the compounding asset is infrastructure plus regulation. Data privacy rules that require local storage create durable demand for local data centers. Undersea cables, power contracts, and physical campuses turn that demand into long-lived cash flow potential. Lesson 3. The limiting reagent is always the real world. Compute dreams hit the wall of electricity, water, hardware supply, and social legitimacy. The winners are the ones who can scale without triggering a backlash that makes expansion politically impossible. So what's the core question raised by this story? It's whether India can turn being a massive consumer of data into being a global provider of AI services, without creating a domestic political crisis over power, water, and jobs. And here's where I land, based only on what's on the page. The strategy is coherent, the incentives are aligned, and the money is arriving. But the bottleneck won't be capital. The bottleneck will be scarcity. I'll end with one sentence I want you to hold on to. In the AI age, the countries that win won't be the ones with the loudest hype. They'll be the ones that can reliably convert electricity, water, and regulation into compounding compute. Now, towards last article, AI won't kill the software business. The belief that AI will destroy software has already done damage, whether it's true or not. That's the line I want to start with, because it's the real point, not the technology. The belief, the narrative, the story that markets tell themselves when they're tired, when they're looking for the next regime change, when they're hunting for a simple explanation that justifies a sell-off that feels inevitable in hindsight. This is the Wall Street Journal, and the argument here is clean. Artificial intelligence won't destroy the software business, but the persistent belief that it will can still do a lot of damage. And if you're a value investor, you should love this kind of setup, because price is what you pay, but narrative is why you pay it. Let's slow down and make this moment vivid. Software stocks have been sliding for several months, and the sell-off picked up steam in the past few days. The IGV software index is down around 29% from its peak in late September, and the article calls out a brutal sell-off on Tuesday as a punctuation mark. Now, what triggered the latest move? Anthropic released new capabilities for its Claude Cowork assistant. These functions are aimed at legal users and designed to automate processes like contract reviews and legal briefings. And the market did what markets do when they've got a loaded narrative sitting in the chamber. It fired. It started with publishing companies geared toward the legal market, then quickly fed into the continuing narrative that AI tools will disrupt established software businesses. Major software names like Salesforce, ServiceNow, Adobe, and Workday dropped 7% on Tuesday, while Intuit slid nearly 11%. This is how contagion works, not biological. Psychological. One new product release in a specific workflow becomes proof of a sector-wide extinction event. Now, I want to identify the central figure in the story, and it's not a CEO, it's not Anthropic, it's not even the software vendors. The central figure is the market's narrative engine. The market is the allocator of capital, and it is also the allocator of fear. It can decide in a week that what used to be a stable compounding business is now a melting ice cube. And once that belief is installed, companies are forced to operate under it, even if it's not true. But there is a counterweight. Jensen Huang shows up in this piece like a reality anchor. NVIDIA's CEO, the person whose company is effectively a key enabler of today's AI industry, says on stage at Cisco Live, "There's this notion that the software industry is in decline and will be replaced by AI, and it's the most illogical thing in the world, and time will prove itself." That quote matters because it's not coming from a software vendor defending its revenue. It's coming from the guy selling the picks and shovels. Now let's tackle the core claim, why the extinction narrative is exaggerated. The article makes a point that every operator understands, but every market occasionally forgets. Highly complex software platforms run mission-critical tasks like payroll and IT management. They require deep subject matter expertise that goes well beyond writing code. So the idea that corporations will replace these platforms with vibe-coded apps is described as a stretch. And that's the real intellectual mistake, confusing the ability to generate code with the ability to run an enterprise. Code is cheap. Governance is expensive. Compliance is expensive. Reliability is expensive. Migration risk is expensive. The switching cost isn't just technical, it's organizational. Now here comes the inflection point that makes this a real investing problem, not a philosophical debate. Time isn't waiting. The market is volatile and eager to find signs of AI disruption. And on top of the narrative pressure, software companies previously seen as AI winners have issued disappointing quarterly reports, adding another cloud. A KeyBank analyst, Jackson Ader, notes that reports from Microsoft, ServiceNow, and SAP were underwhelming or disappointing, which means the so-called flight to quality trade may not be totally trusted. Translation: even the safe software names aren't being rewarded for simply being incumbents. And now, software vendors are in the worst possible position psychologically. They have to disprove a negative. To counter fears, they need to show acceleration in revenue growth. But the article says that will be difficult in a time of tightening corporate spending and large-scale workforce reductions. Then you get the number that shows the macro backdrop in one stroke. Amazon, UPS, and Pinterest announced plans just last week to eliminate as many as 46,700 jobs. Layoffs matter for software because a lot of cloud software is sold per seat. Less headcount can mean fewer seats. At minimum, it changes the negotiation. Now we're at the part value investors should focus on, the contract renewal battlefield. Big customers are investing in internal AI projects. These projects may not be designed to replace the software platforms they use, but they can still consume IT budget dollars and management attention. That's the key nuance. AI doesn't need to kill a software vendor to hurt it. It only needs to make budgets tighter, make renewals more contentious, and give customers leverage. The article says exactly that. Customers can gain additional leverage in contract renewal negotiations, especially because many software providers just closed their fiscal years in January, when AI disruption fears were surging. That raises the prospect of heightened pressure on margins and, in turn, growth. This is the difference between software dies and software derates. For a compounding business, the scariest thing isn't bankruptcy. It's a permanent reduction in pricing power, a gradual decay in renewal economics. A little more discounting every year, a little more services work bundled in, a little more concessions. Now, let's handle the visuals, because this page gives you evidence that viewers will see on screen. On screen, you see a simple chart titled Index Performance Past 6 Months. It compares the PHLX Semiconductor Index, the NASDAQ Composite, and the IGV Index with dates around September 2025 and January 26, and a percentage scale that runs from -40 to +60%. This chart is doing something subtle. It's telling you the market has been rewarding the AI infrastructure side of the trade more than the software side, and it's compressing the middle. It's a visual representation of narrative allocation. You also see the statement about valuations. The average multiple of companies on the IGV index has collapsed from 39 times forward earnings to about 21 times now, based on FactSet. That looks like value. But the article immediately warns you. Those figures are mostly based on analyst estimates that exclude stock-based compensation, which can be deceptive in software. That's a crucial footnote, because the software business model often reports earnings that look cleaner than the owner earnings a true long-term investor should care about. Stock-based comp isn't just an accounting item, it's a claim on the enterprise. Now, the reality check section. The uncomfortable truth. AI won't eliminate the need for specialized software platforms. But survival alone isn't enough to claw back recent losses. That line is the investor's punch in the throat, because it tells you what the market is demanding now. Not existence, not relevance, growth, evidence, acceleration, margin protection. And here's the deeper reality. Even if the extinction story is wrong, the other dangers are real. Tightening corporate spending means slower growth. Large-scale layoffs reduce seat counts or at least reduce the urgency to add seats. Internal AI projects soak up budget and attention. Renewal negotiations get tougher, which pressures margins. And all of this can happen while the core products remain indispensable. That is the tragedy of great businesses in a narrative downturn. They can stay great and still underperform. Now I want to extract 3 lessons that matter beyond software. Lesson 1. Markets don't wait for truth. They front-run fear. The time to think clearly is when the chart is red and the narrative is loud. The time to buy is when you can separate extinction from margin pressure and price them differently. Lesson 2. Disruption often shows up first as bargaining power. Customers don't need to replace you to hurt you. They just need credible alternatives and competing priorities. Leverage is enough. Lesson 3. Valuation compression creates opportunity only if you understand the unit economics after dilution. A forward P/E collapsing from 39 to 21 looks like a gift, until you remember stock-based compensation. The real question is what the business earns for the owners after you account for the equity it continually issues. Now let's answer the core question raised by this piece. Will AI kill the software business? No, not in the way the story is being told here. The idea that mission-critical platforms just get swapped out for vibe-coded apps is not how real enterprises behave. But will AI change the software business enough to justify a lower multiple, slower growth, and tougher renewals for years? That's the real risk. And the article is telling you that risk is already here, in the form of fear, layoffs, budgets, and leverage at renewal. I'll end with one sentence you should keep on your desk. AI doesn't have to replace software to break a software stock. It only has to break pricing power. This is Avi. Like and subscribe. On to the next.